Hello, I'm Bernard Hickey from interest.co.nz and welcome to an investing special. Today we're going to look at mortgage trusts. We don't normally have a look at these, but there's a couple of interesting situations developing and a couple of fundamental flaws that we can see in mortgage trusts. It's worth discussing in the wake of the closure of the Canterbury mortgage trust this week. It had $250 million worth of money in that trust. And the closure of the Tower Plus mortgage fund back in April, it had $242 million. So what's the problem here? Mortgage trusts have two fundamental problems. They often have funding mismatches, and secondly, they're also quite exposed to residential property investors and developers. Firstly, that funding mismatch. What am I talking about here? This basically means that many of the trusts have borrowed short-term, but are lending out long-term. Essentially, if I'm an investor in a trust, I put it in and I get a variable interest rate, and I can expect to withdraw that money in about a week, at most 90 days. The trouble is, the trusts lend out for 6 months or longer. So if everyone turned up at the front door wanting their money back, it simply couldn't be delivered. The second risk for mortgage trusts is that they're often exposed to property developers. It's interesting to have a look at some history here first. Mortgage trusts often developed out of the lawyers' loans market in the 1980s and 90s. When you were needing a bit of short-term money, a bridging loan, let's say you'd bought a property, you were trying to sell your house and you needed to move into the next one, you went to a lawyer, they provided some short-term money, and it just greased the wheels as the property market went along. Now that's all fine when houses are selling quickly and the market's in good shape, but right now it's not. If you have a look at these two charts, they show what's happening to volumes in the housing market and what's happening to days to sell. Now, volumes have halved in the first 6 months of this year compared to last year, and also the days to sell has jumped out from about 30 days to about 50 days. And we actually think in many cases that 50 days understates how long it's taking to sell a house right now, because people are often changing agents. So this means that these mortgage trusts often lend short-term, 3 months, 6 months or so, often to either property investors or property developers. And this was the problem, particularly for Canterbury Mortgage Trust. Turns out half of its loans were to residential property investors, and $50 million of that was on development properties. And of course, many of these properties are in deep trouble right now. They simply can't sell the apartments or the units or the villas. Turned out too that Canterbury Mortgage Trust had a 21% loan arrears rate. What happens when you can't sell the property and you've got this short-term loan? You may not be able to pay the interest rate on it. And let's have a look then at some of the other mortgage trusts around who have got quite a high exposure to property and also have this same funding mismatch problem. The New Zealand Mortgage Income Trust, over a third of its lending is on residential investment property or development, and 9% of its loans are in arrears. That's almost triple what it was a year ago. We're going to dig deeper into the mortgage trust sector. Keep an eye on interest.co.nz and we'll bring you those reports. I'm Bernard Hickey with a special investing report on mortgage trusts.